Good morning, good afternoon, or good evening, depending where you are on the planet, and welcome to the Thursday, the 30th of May, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. Welcome. We're going to go through our usual regular run through here today. We'll take a look at the calendar, what we've had, what we've got coming up on the data calendar. We'll take a look at some articles from the major news wires to see what are the major influences affecting the prices of the markets you're trading right here, right now, from a macroeconomic, geopolitical, central bank, etc., perspective, and then we'll take a quick look at the charts as well. So, just one thing to point out, I've been pointing out this all week. The Fed meeting in June is the 11th through 12th of June, with the meeting on the 12th. A week and a half before that, we enter the Fed's blackout period. So that comes into effect on the 1st of June, which is this Saturday, as you can see in here. And so today, tomorrow are the last chances we're going to have for Fed speakers to speak on interest rate policy. So blackout, back to enter the blackout period. We have had some Fed speakers over the last 24 hours, or the last 24 to 48 hours, and the tone remains very hawkish in here, to the point of Kashkari, who is on the more hawkish side, even highlighting potential that rate hikes have not been taken off the table yet. So as much as we're looking and expecting and anticipating rate cuts, saying that rate hikes are not fully off the table. And that's, after we've had, obviously, still, relatively stubbornly high inflation, not high compared to where it has been over the last, 1 to 2 years, but then equally is not down to the Fed's level. And global inflation similarly stubborn in not moving down towards that 2% level, sticking around, globally we're anywhere with, 2.5, 3.5, 4% in the major economies. So concerns around that. And then also the Fed's, particularly from the Fed's perspective, the US economy is remaining very, very strong. We had that consumer confidence data already out this week. The labor market stays fairly strong. The consumer stays relatively strong. Production numbers, various data stays relatively strong. So why are we cutting rates if the actual economy is not in need of it? So all of those things in here, of concern on the rate side and being voiced by the central bankers. And then even if we do start to slow down with rates, if the economy does start to slow down and inflation rates are stubbornly, not moving towards that 2% level, then there's concerns that we could go into more stagflation. So inflation stays stubborn. It's not super high like it was, but still above 2%. And then we could see a slowdown. So, there are concerns on both sides. Either the economy stays strong and then there's no need to cut, or the economy starts to weaken, but inflation doesn't come down. So the combination of those from the Fed speakers more recently, the tone has definitely been more hawkish, and then that's been very, very much reflected, but more of maybe exaggerated. We also got the bond auctions in here, which weren't covered as well, showing a lack of demand for bonds, and that sort of feeds into the same places we've got with the concerns about maybe we're not going to get rate cuts, or concerns about the economy. So less of a the lack of strength on the bond auctions in here, seeing bond prices go lower, so bond prices down equals yields higher. So we've had a spike in yields. We saw that 2 days ago. I spoke about it yesterday on the webinar, and then we got a follow through yesterday to higher bond yields across the yield curve. We'll look at the charts on those shortly. And higher yields are negative for stocks. Higher yields negative for stocks, particularly for growth stocks, and higher yields, higher interest rates, obviously just negative overall potentially for the economy. So moving just quickly to the data in here. Going into today, we do get this slew of data in just under 1 hour. It is the preliminary GDP number in here we do, but it's quarter on quarter for Q1, right? We are now about to enter the 6th month of the year. So this is quarter on quarter data for Q1. It's very, very backward looking, right? So even though we're getting that preliminary data in here for quarter on quarter for Q1, it's very backward looking. So this data rarely has a big impact. I'm not saying on the release of the data the market might spike somewhere, but it rarely moves sustainably in one direction or the other. Now, if it's very, 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 very out of line, that's different. Okay, but generally speaking, even if it's slightly out of line, it doesn't have a big impact on the market. Even though in the big picture, it's super important for the economy, right? This is the growth of the economy. That's what GDP is. But for short-term trading, it rarely has a significant impact. Moving down the calendar in here, we also get William speaking today, 12:05 Eastern. I think that's the only major Fed speaker. So today, tomorrow, the last chance for the Fed speakers. But talking about those Fed speakers in here, we did have Bostic on the wires. We still have a ways to go. Now, Bostic is he's either in the middle or towards the dovish side. So even with one of the more dovish sides, on the sticky of his saying that we still have a ways to go. So that's a concern in here. Stocks down with treasury yields up at their highest levels, up near the highest levels of the year in here is the concern. Okay, so we've got bond prices going down, bond yields up, pulling stocks lower in here, and that being driven by, say, those auctions and being driven by the voices within the Fed. Some other stuff in here I don't think really significant for what not really impacting softwares and PC. Salesforce shares plunged in here. Barclays sees signs of weakness in the IPO market, is slowly turning, and then rafts of US data, which we've already spoken about already in here today, as we have coming up. So here's some of the articles in here. So Fed's Bostic says many inflation measures moving to target range. Yes, they are, but Fed especially may be in a position to cut in the fourth quarter. So even one of the more dovish now looking for the fourth quarter. So kind of saying maybe not even the September cut that we were potentially looking for. And the breadth of recession is still quite high. And remember, if anything, Bostic is a little bit more on the dovish side generally. If we jump to one of the hawks, the hawks in here, Kashkari says interest rate hikes not entirely right out. Remember, hikes is up, right? Increases. Says odds of rate hike low, but not taking it off the table. So we're not saying he is good, but then if he's still keeping hikes on the table in here, right? Then is there a potential then for that he's just saying no rate cuts this year, right? So still sees policy as restrictive. Fed can wait for more data. So waiting and seeing is becoming lower for staying at these levels for longer is potentially what we're going to see. And US stock futures, obviously, we were down yesterday, down again in here on the overnights in here. So Salesforce, I don't think it's having a massive impact. I think it's more all about these yields in here. And then just on that, just on what Kashkari says, rate hikes can't be turned out. In the options markets, in here, we are seeing some trades in the options markets in here, betting on potentials for rate hikes. Okay, so and it's not the core positioning, obviously, but there are. Considering it was something we weren't really, anticipating at all, there has been activity in here. Revived hike chatter fuels higher for longer options wages. So either for rate hikes or for just higher for longer. Okay, so rates staying where they are, not moving back lower from here. Similar stuff covered in here on Reuters. So biggest month of bond supply to test markets. We've spoken about that already. That continues in here. Stocks bonds steady after rate ank sell-off. So that was from yesterday in here. And agitated markets are wary of June heat in here as well. So markets concerned as we go at the end of May and into June. Okay, what else? So just on a quick look at the overnights in here. Asian stocks following their US counterparts lower overnight this morning. So that Nikkei and the Hang Seng both down around 1.3%. European exchanges actually holding in, having suffered losses again yesterday. The FTSE's actually rebounded nearly 0.3. The German DAX pretty much unchanged, and the French CAC up about 1/4% this morning, and we're down lower again in here. So the Dow, leading the way down here. The futures down nearly 9/10 this morning. The S&P down 4/10, and the Nasdaq down 3/10. Surprising that the Nasdaq is actually getting impacted less, given that this is being driven, remember, by the potential for interest rates to be sticky in here. So if we jump to the Fed watch tool in here, we've been kind of watching this, and it's been moving that way. So look, I mean, this is just tiny for potential for a rate hike, but now in here by September, it's kind of 50-50 now in September, whether we get a rate cut in September. So the odds are really moving out more to November. But even by November, if you add these here together, 38% chance was still unchanged in November. And then now by year end in here, we have basically a 19 to 20% chance in here we're unchanged. But now really the chances are, really, if you look at these, add these together in here, what are the chances of us having only one rate cut by the end of the year? That's where the bet is, really. So it's 62% chance of only one rate cut, with only 39% chance in here of more than one rate cut by the end of the year. So really the market is now just pricing in one rate cut in Q4 is where the money is. What else do I have for you? So yeah, here's the bond chart. So we know bond prices are down, bond yields higher, 10-year bond yields. I'm going to jump to my analysis and we'll let that load in the background. But yeah, so if we look at we've been following this anyway. We only went negative on this a couple of days ago on the 30-year, but you can see plunging lower US 30-year bonds in here, and 10 years in here getting close to levels seen earlier this year. The low prices eroding all of the support that we built up through May in here, back down towards April lows. And if we go to the shorter end, 5 years and 2 years, getting close to the lows that we posted in April/May. So still very much a negative tone on the bond side. And just going back to that yield chart in here, I'll just pop it out. You see in here yesterday, 2 days ago, we accelerated higher on Tuesday and again higher yesterday, and approaching these bond yield highs up around 4.74% on the 10-year that we posted at the end of April. So we have had a little bit of respite this morning, but the futures market on the equity is not listening to that, watching that. So despite the fact that we've had a slight lower yield, higher price bias, hasn't helped stock indices on the overnight in here. And finally, I'm hanging on in the reports in it to a bullishness, but you know what, we're edging down towards some important support. And if we take out the support levels in here on the Nasdaq, and the first support levels, Nasdaq and S&P, it all looks very, very vulnerable. Just a quick look in here on the she's got big gold double top forming in there on gold. But if we go to now, we should be rolling. I'm going to just keep it on the June chart because we're not actually looking at trading this. But here's the 2-year note. So you see the 2-year note getting very close to the lows posted in here at the beginning of May. So if we take those out, then that's going to look even more vulnerable. That's on the June contract. You should probably be watching the September contract as well. And you can see in here wiping out support in here. But we have had a slight rebound on the bonds. So even though we had this slight rebound in bonds, remember, these are positively correlated with stocks at the moment. So the acceleration down over the last 2 days in the bond market in here has been negative for stocks. But this little bounce we've not seen, then that been reciprocated on the stock. So we've seen this significant sell-off. Stocks have had a little bit of a rebound in here this morning. Nasdaq, you can see coming off, but they're still down in here. So we have had a slight rebound, but still looking more negative than bonds, which is, seeing the bonds have led us lower. So this is really, I think, interesting. 13-period EMA in here is sitting at 18.6, basically 18.685, 18.690 in here. I think that, if we get a close below that today, then things could look very, very negative for the Nasdaq. But you can see we're still inside. So all the activity since this is last Thursday post Nvidia, all the price action so far since last Thursday has been inside that daily pattern. Now, there is a risk if we take that out that low. I think that's going to be critical in here, both the combination of how it deals with going into the close today, the 13 period EMA on the Nasdaq. That's say 18. Well, I've got it bang on 18,687 at the moment, but in that area there, and then the low 18,621.5. Those are going to be the critical kind of levels. The first one on a closing basis, and I know you're day trading at Trader, but I think just monitoring how it deals with that EMA, not looking to buy and sell it above and below, but looking if the more activity we get below that EMA, the more threat we have then to the low from last Thursday. And if that goes, then it looks very, very negative. And keep an eye on the bonds as well, because if the bonds start to rebound, if we get a rebound in bonds at higher prices, lower yields, that could help with a little bit more of a rebound in the stocks. But you look at the S&P, looks more negative, far more negative than the Nasdaq. So the Nasdaq, the S&P already wiping out the low in here, okay, the previous low at 52.73.5, and took that out yesterday. It's closed yesterday below the 13 period EMA. And we had a slight bounce here this morning, but I think the S&P looks more vulnerable. But you're looking for probably the next trigger point coming from the Nasdaq and whether it can hold that Thursday low. If last Thursday's low goes on the Nasdaq, then it's going to pull both stock indices more likely to go lower, with the major support levels now already surrendered. There's nothing really. That's the next big level here, down here on the S&P, on this swing lower from over here, which is down at 52.16.75. So that's going to be the next big line in the sand on the downside. So for me, there is kind of a slight downward pressure, but do keep your eye on the stock indices. Keep your eye on those levels on the Nasdaq. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another bull versus bear webinar to round off the week for the TGI Friday webinar. Take care, guys.